Welcome back, everyone. Michael here with Offshore Citizen. Today I'm going to discuss with you the subject of lower risk DeFi investments. So if you've taken a look at the market right now, you've seen that we're talking about specifically crypto markets here. The prices have shot up to crazy levels, and as a result, the market is seeking the yield. So what happens? The market is trying to find where money will go and chasing yield. And as a result, if you go back to when I was mentioning to you guys in early December projects, you could choose good projects at good prices. Those projects went way up, 6, 8x, things like this. And then there were some others that kind of trickled down. Well, now it's trickled down to the point where projects that are nothing projects, they're dead projects, are pumping like 50% in a day. Which, if you hold those projects, that's great. But for example, Bitcoin Gold, way up, Bitcoin Cash, way up. On and on and on, right? A bunch of these things are flying, but really they don't have real substance behind them. And so to me, the predictability of that, trying to say, hey, listen, I'm kind of trying to guess what's going up, is really tough. And at the same time, the risk that it crashes down is much greater. So basically, this is my underlying mindset. My underlying mindset is if I buy a solid project, then the probability that a solid project goes up is greater than the probability that a not solid project goes up. Number two, in the event that they crash, a solid project is on average going to crash less than a not solid project. Okay, so it's certainly far from risk-free, far from not speculative. It's of course speculative, but it's just less speculative, and so offers kind of some degree of comfort and safeguard. All right, okay, cool, makes sense. Well, so then what do you do in this environment? To me, the thing that I want to talk about today in this video are other options within the space that are still like insanely high yield that in any other field, you'd just be like, this is nuts. I'm like super excited to get these yields. But the risk is dramatically lower, or strategies to increase your returns while decreasing your risk simultaneously. And so we're going to cover both of those things. So I'm going to go through kind of in this space of DeFi, because think about it this way, right? This is kind of like, if you could invest in the internet in, the late 90s, what was that? That was a great opportunity, right? Same sort of principle here. If you can invest in this space, there's a lot of opportunities. There will be ups and there will be downs. Things will crash. People will get wiped out. There'll be all kinds of stuff that will happen. But in the macro, if you had bought Amazon in the 90s, you're super happy that you have Amazon today, right? So same principle here. Okay, so we're going to cover that. I'm going to give you guys some specific sites that you can go to, some specific tools you're going to look at, some specific things that I am doing, and it will kind of uncover for you some areas that the market maybe hasn't discovered yet, so it's a little bit ahead, and yeah, hopefully it's a bit helpful to you. So before we do that though, if you haven't already, please smash the subscribe button, nail the notification bell, make sure you don't miss out on any of our future videos. And if you're interested at all in these subjects, you can reach out and book a call with me, calendly.com/Michael-Rosmer. There's a link in the description below. You can check out our websites, offshorecitizen.net, offshorecapitalist.com. And yeah, we're happy to help you with the strategy of going international and everything involved in that, as well as the implementation. So let's dive into it. All right. So the thing that I'm going to talk mainly about is the cash flow based DeFi investments. DeFi, if you aren't familiar, I have a video on it. It's decentralized finance, and decentralized finance is kind of in contrast to traditional finance, okay? And just because it's so emerging, there's just a lot of mispriced or market inefficiencies that you can take advantage of that just don't exist in cases where there's huge established markets and so on and so forth. And so there's pretty much 3 ways that you can get cash flow in DeFi. These are, number one, lending. So you can take the tokens that you can have and you can lend them out and you can get a rate of return on that, which again, if you're getting cash flow and you're holding it anyway, of course you're exposed to whatever the underlying volatility of the asset is, but you're at least getting some return on it. Plus, and so that means that, that boosts your return if it does well, and it decreases your loss if it goes down, right? The second is you can do staking. How does staking work? Staking is where you contribute a token into some sort of a pool. Usually, in theory, you could run your own. You don't necessarily have to contribute to a pool, but most people don't have the technical skills to do that. And usually in networks like Ethereum 2.0, in Cardano, in some of these, the whole idea of staking is to help keep the network secure. And I'm not going to go into how staking works in this video, but the bottom line is that there's this system called proof of stake. And when you have proof of stake, that's helpful in order to be able to keep the network secure, which is really, really important to the whole basis of crypto. Okay. All right. The third thing is yield farming. And I've talked about this in some previous videos as well. This is where you contribute to what are called liquidity pools. Liquidity pools facilitate the trading between two assets. Okay, so let's say that I want to switch from USDC to DAI, right? These are two assets. And in a normal kind of market making environment, what I would do is I would have somebody else who I'm going to swap them for mine. But of course, you're never going to find that perfect mix. So they created what are called automated market making protocols. And these combine with liquidity pools. Basically, it's pools of pairs of assets so that whenever somebody wants to trade, it adjusts the pool and makes it work out. And there's some consequences to this. But the point is you charge fees to do these transactions, and those fees go to the people who contributed to the liquidity pool. Okay. So now let's just understand how insane this market is right now. So first of all, I want to tell you, I'm going to give you some percentages. These percentages are not fixed percentages. Okay, that's the thing that you need to understand, number one, because right now the numbers could be really high and they could go down, a lot lower. And we expect that as more people come into the market, as there's more liquidity, et cetera, that number will come down. Okay, because the numbers are crazy. Number two, the numbers that I'm citing for you are what we call APY, okay, annual percentage yield, which is different than APR, which is what most people are used to seeing, okay? So I'll give you a contrast of this so you can understand the difference. If we're talking about APR and you say 12% APR, then usually what a person is thinking is, oh, I'm gonna get 1% a month, right? So you're like, okay, great, I'm getting 1% a month, that equals 12% at the end of the year. APY is calculating the compounding along the way, okay? So it's easiest to see if you use a high percentage, right? Let's just say, for instance, you're talking about compounding at a rate of 10% a month, right? So that would be, it's not 120%, right? Because the 10% is compounding on itself. So it at first is 10%, the next is 21%, then is 10% on the 21%, and then 10% on, and so on and so forth. So that by the time you get to the end of that, I would have to do the math on what it is, but it's probably, at least 3 times greater or something. Like it's probably around 300% instead of 110%. I'm just guessing at the numbers. I haven't looked them up, but something like that. So that principle is going to skew your understanding of the numbers a little bit to make them look bigger than they are in practice. Okay, and so this is important to note. I'm also going to explain to you where the numbers come from so that you can understand how these things get paid. So let's use some examples. There is a project right now on Huobi EcoChain called Filda, okay? So if you want to go look it up on CoinGecko or CoinMarketCap, or there's an explorer there, it's FILDA, and that's the ticker symbol for it. You can go and you can check out their website and things like this. And so they do lending, which means that you can lend and you can borrow, you can contribute to yield farming in that case, and you can do some things with governance, okay? All right, fair enough. You've got this Filda thing. That's on Huobi, so I'm going to use that as one contrast. Then we have on kind of general, more well-known stuff. You have BlockFi, you have Celsius, you have Nexo, you have Aave, you have Compound. These would be some of the well-known kind of lending protocols that sometimes have pools and things like that as well. Okay. Now, if you go to these websites, and I'm also going to mention AutoFarm. Okay, AutoFarm works with both Binance Smart Chain and with Huobi EcoChain. Okay, I'll explain to you guys in a minute how you would get connected if you needed to do this or wanted to do this, but just be aware of how this goes broadly. So if you want to look things up right now, look up AutoFarm, look up any of those I mentioned: Compound, Aave, BlockFi, Celsius, Nexo, etc. Right, and then you can look at Filda. Okay, so for some contrast. And what I'm contrasting for you here in particular, Filda is the least developed market, okay? Least developed of these. So if I was to start, I would say, okay, Aave, BlockFi, et cetera, these guys are all the most developed, right? And so therefore we see the least market inefficiency, right? Then there's AutoFarm, which has more market inefficiency. And then we've got FILDA, which, as we're going to see, is more market inefficiency. Okay. All right. So if I was to go and I was to take money right now, let's just say for an easy situation, I had something like USDC, USDT, BUSD, DAI, things like stable coins. Okay. So understand that when you have a stable coin, your level of risk and your level of volatility is quite low because it's just designed to match typically the US dollar, although there could be some other pairs as well, but typically the US dollar. So you're not getting involved saying, oh, I'm worried that it's going to go up 10x, but it's also not going to crash down 80%, right? You're within a margin of error, fairly confident that it is more or less going to maintain a level similar to the US dollar in these examples, okay? So you've taken kind of that risk off the table. Or not entirely eliminated it, but majority eliminated. And by the way, of course, the US dollar could, fluctuate, so of course it's following along accordingly, right? So I could go and I could deposit onto one of these, and what am I going to be able to lend it out for? Maybe I can lend it out for, if I was to go to Celsius, I'd have to check right now, but maybe I can get like 12% on my money, right? Now it turns out that 12% cash flow on your money, on say US dollars, is actually a really good return, right? It's a lot better than going and putting your money in a bank, right? I'm not a huge fan of centralized services because or custodial services. I want non-custodial, so I like things like Aave instead. But anyway, the point is you can go and you can use those. And they'll have different rates, okay? They're saying, okay, great, the borrow rate is this, the lend rate is that. All right, or I think they call it earn on some of these sites. That's one way to go. And what some people will do, by the way, is they'll go and they'll deposit their tokens, they'll get money, then they'll borrow against their tokens, they'll get money, and then they'll go buy more tokens, and they'll cycle this, right? Which is probably not really so good for them because if they have a liquidation, it's like a big collapse. But that being said, this is the nature of the set base right now. Number two, I could go to Auto Farm. If I go to Auto Farm right now, I can probably do USDC or something like that at a rate of around 29-ish%. That's crazy high, right? Like if you just think about this, you can take your US dollars and you can deposit them and you can get 29%. That's insane. Now, please note, what that does not mean is that you will deposit the money for a month and get, whatever that would be, 2.5%. You will not get 2.5% in the first month because it's calculated compounding, right? That's the APY thing. And some of the rewards, may be paid in another token, which is the auto token, okay? So you have some degree of risk and concern with respect to that as well. Now let's go to FILDA. In FILDA, I can do probably around 59% or 58%, like somewhere in that range, for the same asset, okay? So what there's this whole market of these days is people who just pay attention to where the greatest fees are being paid and they move their money from one to the other. These are kind of like the yield farm degen people, as they would refer to it. And there's groups devoted to this, and there's daily reports that come out to see where's the best yield and what are the best pairs. And if you have a decent amount of money, I know people who have had hundreds of thousands of dollars that they're earning 100% a year on stablecoin pairs, right? So their risk of when you get into yield farming, you have the added risk of impermanent loss. But when it's stablecoin pairs, there's very minimal risk of that because they're both kind of fixed to each other, right? And so nuts, right? Just nuts returns. Now, that's just talking about if you're talking about stablecoins. Here's the thing. Let's say that, some things that I'm very confident long-term in something like Chainlink, okay? I think if you're going to hold Link over 5 years, it's a very solid project. Okay, very solid. The use case, they're the market leader. The use case is only growing. The reasons for using another alternative as opposed to them are minimal. The ability of them to go and to continue to iterate and copy if there's some other feature that comes in, etc. They're in a pretty solid place. Okay, so there's a very good chance that 5 years from now, Chainlink is worth more than it is worth today. We'll see. It could be down. You always have market cycles, but there's I think a pretty high probability bet there. Well, I can go and deposit in a single asset pool on Auto Farm my Link, and I can go earn 10-20%, right? So I'm basically enhancing whatever I think. Let's say I think Link is going to double or something. I can get this added return. That's pretty great, right? That's pretty awesome. Now, to give you some idea, I don't think that 20% is so exciting when you figure out that it's this APY thing. But especially since that's not stable, so over time the price could go down, the return could go down. Maybe it's going to pay you 10% instead of 20 or whatever. But for months, I had cake deposited on Auto Farm, earning in excess of 300%. So this is nuts, right? 300% is insane. And by the way, that's a single asset pool, so there's not the risk of one having to trade into the other or anything like that. So what did I do? I just enhanced my returns, right? It turned out I did very well on cake. I did 2 different rounds on it. I just sold out recently. And in both times, I got big returns, but those returns were enhanced by this. And what I felt very confident in was if it went down, I'm like, hey, it's fine. I'm willing to wait because I'm in a situation that I'm earning 300%, So at 300%, if it just stays the same for a year, I'm happy. Now let me go and tell you how much better this can be. I deposited Filda not long ago, which Filda was up insanely because it got listed on one of the exchanges, at 810%, okay? This is like ridiculous. Now, here's my point. Because, of course, that 800% won't sustain itself. And it's entirely possible that that token drops dramatically. Like you're exposed to the underlying volatility of the underlying asset. My point of this is not that you're necessarily going to get 800% or that you should expect that or anything like that. Like that is not the case here at all. There's lots of concerns. But if I'm going to hold something like Filda anyway, which I was holding anyway, I can reduce my risk and increase my return by going and putting it on here. And I think it's something that not many people are doing. So how do you do that? So you would use MetaMask typically. Okay, so if you don't have it already, you can go set up a MetaMask. I have a video where I went through explaining like the whole thing of how to set this up. So you can go and check that out, or there's lots of videos on how to set up MetaMask. In the case of Filda, it's Huobi EcoChain. So you need to enter, there's like the network information. So you have to Google like how to configure MetaMask for Huobi EcoChain, right? If you're doing it for Binance, you have to go Google how to configure MetaMask for Binance Smart Chain, okay? Then you need to get their base token. So in each case, each network has its underlying token. So on Ethereum, on Ethereum, you have Ethereum. On Binance Smart Chain, it's BNB. On Huobi EcoChain, it's Huobi token, okay? So to get that token, you have to open up a Huobi exchange account, right? So you can go, there's nothing really required at all to just register. You can transfer funds in, you can convert to some HT as the token, and then you can send that to your wallet there. Now, obviously, then you're going to need whatever asset it is, right? So you may actually say, okay, I'm going to buy a whole bunch, and then where would you exchange? So if I'm exchanging on Binance Smart Chain, I'm pretty much always going to PancakeSwap, right? So you can go and check out their place. Or if I'm exchanging on Huobi EcoChain, I'm almost always doing that on MDEX, okay, MDEX, and you can go and just punch in MDX on CoinGecko, and you can see, and there'll be a link to there. So you can go to coingecko.com, go into the search in the top right, click on it, type in MDEX, click on the thing, go in, and if you just scroll down, you'll see their website, and you can click on it, and you can go there. So anyway, this is like a little intro to just some of the opportunities. This is like a tiny fraction of the opportunities that are out there. There's like insane opportunities out there. This is like, yeah, it's very, but I think it's something that not a lot of people know of right now. To give some idea, I think I saw the stats the other day that there's 45 million Coinbase users and only 100,000 people doing yield farming. So there's this massive space that has yet to grow and represents a huge opportunity, and so something that you might want to look into. So anyway, I hope that was helpful. If you have questions, please put them in the comments below. If you're interested in help with this or international structures, international living, etc., please reach out to me, book a call, calendly.com/Michael-Rosmer. Check out our websites, and I'm going to see you guys on the next video.